Hi friends, today in this video we'll learn how to prepare the balance sheet. In our earlier videos also we have seen how to prepare a balance sheet. We'll take it further. Extract of balances from ledgers of Sunil Traders are given to you as on 31st March 21. So in the books of Sunil Traders in the ledger accounts there are some balances left in some accounts. Using these, we have to prepare the balance sheet of Mr. Sunil Traders. Land 10 lakhs. That means land is showing a debit balance of 10 lakh. Building is showing a debit balance of 20 lakh. Machinery, furniture, stock, closing stock, debtors, bank, cash. Creditors is showing some balance. Loan from bank, capital account. Now, these balances are not going to be transferred to either the trading account or the P&L account. These are not expenses. These are all assets and liabilities. These balances will continue in the books of accounts till the accounts are settled. So till the time we sell away our land, this land account will be there in our books. So till the time these account balances become zero, these accounts will continue in our books. These balances have to be shown in a sheet called as the balance sheet. So what we are going to do is we are going to prepare the balance sheet of the trader. We'll write here. Balance sheet of Messrs. Sunil Traders as on 31st March 2021. Liabilities rupees, assets rupees. Now land account is an asset. It is showing a debit balance. This account is not an expense, so it cannot be transferred to the trading account or the P&L account and closed. So we'll show it in the balance sheet. Land 10 lakh rupees. Building, again building is an asset. It is not going to be closed. The balance will be shown in the balance sheet. 20 lakh rupees. Machinery, it is an asset. It is going to be shown in the balance sheet. 5,50,000 rupees. Furniture is an asset. It is going to be shown on the asset side of the balance sheet. 2,50,000 rupees. Stock, closing stock, that is the stock of goods which have remained unsold at the end of the year. This can be sold and income generated in the next year, so it is shown as an asset in the balance sheet. Debtors, this is the amount collectible or the amount due by the customers to the business for the goods purchased by them or the services enjoyed by them. So it's an asset for the business. We'll collect this money in the next year. Bank balance, it's an asset for the business. 1,50,000. Cash balance 50,000. So all these assets are shown on the balance sheet asset side. Now we have some credit balances. Creditors, this is the amount owed to outsiders, so we'll show it on the liability side. Creditors 3 lakh rupees. Loan from bank, this is a liability for the business. We have to repay it. Till the time we repay it, we cannot close this account, so this account will continue in the balance sheet. Then capital is also a liability for the business. Capital account balance 39,50,000 will also be shown on the balance sheet liability side. So this is how we prepare the balance sheet. Now we have to total both the asset side and the liability side, and balances should tally. 39,50,000 plus 8 lakh is 47,50,000. 47,50,000. So 10 plus 20 is 30, 35,50,000, 38 lakhs, 43 lakhs, 43 lakhs plus 4 lakh is 47, and 50,000 is 47,50,000. Now, if you see the balance sheet, it is showing you that the business owns assets worth 47,50,000. It has liability due to outsiders of only 8 lakh rupees, and the balance 39,50,000 belongs to the owners or the promoters of the business. So this business is very healthy. Out of the assets worth 8 lakh rupees have been purchased with the funds of outsiders. So let us suppose we sell away all the assets, we get 47 lakh 50,000. We will repay only 8 lakh to the outsiders and the owners will be left with 39 lakh 50,000. So this is a good financial condition. Suppose the condition is reverse. You have capital of 8 lakh and loans and liabilities of 39 lakh 50,000. Now the financial condition is not that good because most of the assets have been funded out of the loans but taken from others. So if you had a reverse situation of capital being only 8 lakh and loans and creditors being 39 lakh 50,000, that means if I sell away my assets, more than 90% of the amount will go to outsiders and the balance 10% will belong to the owners or the suppliers. So that is not a good condition. So this is how the balance sheet tells you the position of the assets and liabilities. Balance sheet actually contains the balances of those ledgers which are not closed. Now these account balances have to be transferred to the next year. That means on 1st April 2021 in the journal we are going to pass an opening entry. These balances have to continue in the next year's ledger books or the new ledger book for the next year. These balances have to be taken to the next year's ledger accounts by passing an open entry. This is the first entry we pass on the first day of the next year. So what we are going to do is we have to bring down the balances into the journal in the next year. Assets will continue to show a debit balance, liabilities will continue to show a credit balance. So we'll pass the entry land account debtor. We have to take the balances, same balances. Land account debtor 10 lakh. Building account debtor 20 lakhs. Machinery account debtor, what was the balance? 5 lakh 50,000. Furniture account debtor 2 lakh 50,000. Now this will become not closing stock, opening stock for the next year. Opening stock account debtor 5 lakhs. Debtor account debtor 2 lakh 50,000. Bank account debtor, bank is showing a debit balance of 1 lakh 50,000. I think yes, 1 lakh 50,000. Cash account debtor 50,000. So we are debiting all the assets. We'll credit all the liabilities to creditors 3 lakhs. It will show a credit balance. To bank loan 5 lakh. To capital 39 lakh 50,000. So this is the entry we pass in the books of accounts for the next year, that is on 1st April 21. And then what will we do is these entries will be posted in the ledger. We'll go to the ledger, we'll open land account, we'll write brought down 10 lakh. We'll open building account in the ledger and write brought down 20 lakh. We will open machinery account, we'll write brought down 5 lakh 50,000. We will open furniture account, we'll write brought down 2 lakh 50,000. We'll open opening stock account, simply write brought down 5 lakh. We'll open debtors account, write brought down 2 lakh 50,000. Bank account, we'll write brought down 1 lakh 50,000. We'll open cash account and write brought down 50,000. Then we'll open creditors account, write credit side brought down, or it is showing credit balance brought down 3 lakh. We'll open bank loan account, we'll write brought down 5 lakh. We'll open capital account and write brought down 39 lakh 50,000. So this is how the entry is posted in the ledgers in the books of the next year. So the balances which are not closed, the debit balances in the assets and the credit balance in the liabilities are shown on the asset side and the liability side, and the balance are brought into the books of the next year by passing an opening entry. These accounts showed debit balance in the last year, they will also continue to show debit balance in this year. These accounts showed credit balance in the last year books, so this will continue to show credit balance in this year's books also, in the next year's books also. Once we have opened the ledgers in the books of accounts of the next year, these ledgers can be used for recording and posting of the transactions for the next year. So this is how the account balances of those accounts which are not closed in a year travel in our books of accounts. First, at the end of the year they are shown in the balance sheet, and in the next year they are shown in the journal by way of an opening entry, and the balance are posted in the ledger of the next year. Thank you.